it's a really tough environment, toughest I've ever seen.
Yeah, it's very tough, but for someone who needs returns, maybe it's the only option they have to at least try to get something better than US equities will offer for the next maybe 10, 20 years.
Yeah, well, I certainly can't, tell people to do otherwise. It's a desperate time. So some of these strategies may work. I don't know.
Desperate times need desperate measures.
That's good.
Do you think there is potentially useful information in market valuations measures, such as the CAPE ratio, which could help inform withdrawal rates when these measures are adapted on a regular, possibly annual basis, as compared to simply using a Guyton-Klinger guardrails?
Are you talking about the CAPE? I'm sorry.
Yes.
Yeah. The CAPE is one of the cornerstones of my methods to select a proper withdrawal rate. There are two. I discovered last summer that if you use the CAPE in conjunction with the current inflation rate, you could have accurately predicted historical withdrawal rates as high as 13% in the past for U.S. investors. I mean, we talk about 4.5%, 4%, 4.7%. That's a worst case scenario. Investors in the past who had very favorable circumstances when they retired, which means low CAPE ratio, cheap stocks, and low inflation, which is also great, were able to take 10, 12, 13% out, amazingly, because they enjoyed such very high returns early in retirement. And the low inflation means they weren't increasing their withdrawals a lot each year. So I don't see anything like that in the cards in the immediate future, but it's in the historical record. People were able to do that, and the CAPE is one of the things I employ to study that with inflation.
While the 4% rule is used more as a planning tool, let's say for retail investors, there are better ways to manage sequence of return risk in retirement by using dynamic spending rules. In a 2001 article, you offered the new balance between the constant amount and fixed percentage strategies with your famous floor and ceiling spending approach. I'd like to ask you do you think there are better dynamic spending rules available, like you have mentioned the new CAPE rule you developed?
Yeah, for many years, from when I started up until last summer, I had a real dilemma in my research in that I knew investors in the past had been able to utilize very high withdrawal rates in certain circumstances, but I had no way of accurately determining under what circumstances did they apply to an investor. Today, a retiree, I knew the worst case scenario. That was easy to use. But what if you're not in a worst case scenario? Let's, for example, you're retiring in 2009 and the market has come down and it's cheap and inflation is controlled. Well, it turns out you could have safely taken, I believe, 6.5%. That investor, I've tracked that investor and they're doing very well with 6.5%. So my attempt to create a floor and ceiling and other rules were necessitated by the fact we just didn't have any reliable way to predict a higher withdrawal rate, even if we wanted to take one. But my discovery last summer, where I determined that if you use the CAPE and the current inflation regime, whatever it is, you had a 90% correlation or better with withdrawal rates done historically. I have a lot of confidence that if you use that approach, you probably won't need to make any floor and ceiling adjustments or guide rails or anything because you've established a viable withdrawal rate at the beginning that, based on initial conditions, historically has achieved a higher withdrawal rate than you would be able to otherwise.
While your original paper was designed for capital depletion, right? So to leave no bequest, which
That's
is your
correct.
view on a safe withdrawal rate for capital preservation for different inflation regimes and time horizons.
Is this a situation where you want to leave a legacy or a dollar amount in your portfolio afterwards, or just simply
You want to keep your initial capital inflation adjusted, so not be below that.
I think I looked at that. I wrote a book back in 2006, and that's one of the issues I looked at. It's a look. You have to adjust the withdrawal rate to do that because you're adding another variable, another constraint. So that if you start with 100,000 and you want to, after 30 years, you want to have 300,000 because that's the inflation adjusted value, your withdrawal rate would have to come down a bit to guarantee that from a historical basis. And I don't know offhand. I haven't looked at my book in a while, but I can certainly dig that out. I think I came up with a chart that show the adjustments based upon how much of a balance you wanted to leave in your portfolio. The bigger the balance, the lower the withdrawal rate. That's what it comes down to.
By the way, Bill, let's imagine we are not in a worst case scenario, right? Because these withdrawal rates are used to protect you from that worst case scenario. What happens for an average or median retiree? How much will he have in retirement after, let's say, 30 years or more?
To the average retiree, you're saying?
Yeah.
Most people, I think, about 95% or higher of people who start with a safe withdrawal rate end up with at least as much as they started with, and most end up with a lot more, which is one of the early criticisms of, the 4% rule. People said, well, you're only taking out 4% and you ended up with millions and millions of dollars in your portfolio that you never spent. You could have taken out a lot more, and they were right. But now they're saying 4% is not safe. We should be 2.8%. So now I'm getting hit from both sides.
Yeah.
Before they said you had too much money. Now they're saying there's a risk you won't have enough. If you pick the right withdrawal rate based on methods, I think you can have a fairly high degree of confidence that you will not have, vast sums of money. You have to leave a margin of error. The safe withdrawal rate is based on a zero balance with your last breath. I don't think anybody wants to cut things that closely. You may want to take a slightly withdrawal rate to give you a balance projected so that if something happens, you live long and you figure, you have a margin of error.
Yeah, they are right. But how can you know on an ex ante basis what the market will do? I mean, markets can usually go in extremes, right? Overvalued, undervalued. So you have to play it safe when it comes to retirement because you have no human capital left. But of course, there is this risk that you will have plenty of money and you don't have enough time to consume all of it. I don't know if there is a risk management tool for that.
Well, I think you mean for equities in that situation. I don't know. I think it's important that people recognize that if you start out a retirement with a particular withdrawal rate, you're not married to that rate during the whole of retirement. You should reassess the performance of your portfolio withdrawal rate through time. And I've developed methods for that. For example, the method I use now, you look at the CAPE, you look at the inflation rate, and you look through history to see what withdrawal rate matched that for an investor. And it might be somebody retired in October 1947 or somebody in 1968, and they have a curve associated with that. Then you use that curve as a template. And each year you track your own portfolio against that historical portfolio. And if you stay fairly close to it, you're okay. If you start falling behind, then you got to start asking, do I need to get more conservative? Or if you start running, that you have so much more money than you expected, then perhaps you can, spend more. So you need some kind of a standard to compare your year by year performance against.
Where can we learn more about this new rule? You say basically that it incorporates both CAPE and the current inflation or expected inflation?
That's right. Yeah, I wrote an article in Financial Advisor, uh, and I can certainly send that information to you, so you can give that to your listeners. I've written several articles that lay out in considerable detail what I advocate, and then I'm planning to update my book sometime this year, early into next year, because there's so much research since my book appeared 15 years ago. I have an awful lot to add to it, and then I'll also give a very detailed explanation in that of my new discoveries.
This sounds very interesting and lets you adjust the withdrawal rate depending on the market conditions. But I think eventually you still risk having a lot of money in retirement if equities do well, right?
I'm sorry?
I think that eventually you might risk getting too much money in retirement. I mean, you don't eliminate that risk, even if you
Yeah, well,
adjust the withdrawal rates using
I think
CAPE.
it's like any other plan. You have an insurance plan, you have an estate plan, you have a withdrawal plan. It needs to be reviewed every so often, maybe every 3 to 5 years. And there are adjustments you can make. I have two bits of advice for people who are making adjustments. Let's say you're trying to follow a curve from the past, and all of a sudden you hit a terrible bear market, and it throws your withdrawal rate way up above the curve. It should be taking 5%. Now I'm taking 7.5%. Golly, what's happening? Should I pull my ears in? Well, bear markets are temporary. They come and go. And after the bear market is over, you usually get very high returns for a few years. So that people shouldn't overreact to bear markets, late, in the middle or later in retirement, because they're probably going to recover. However, if you get unexpected high inflation early in retirement, and it looks like it's going to be sustained, you need to seriously adjust your withdrawals almost immediately, because if you don't, you can really get hurt very badly. Inflation, high inflation, I think, is the greatest risk to almost all retirees, particularly if it gets a 1970s style and we get double-digit inflation for 10 years. That's catastrophic.
But Bill, CAPE doesn't already incorporate the inflation.
CAPE?
Yes.
Well, CAPE has an adjustment for inflation in there, but it doesn't give you the adjustment that gets made to your withdrawal rate. It's an adjustment, that reflects, the earnings power of companies and how that's changing. You need to use both of them in tandem to really get an accurate withdrawal rate.
I am particularly interested to hear your opinion on the dynamic safe withdrawal rate created by Karsten Jeske, the author of earlyretirementnow.com, who developed this rule for capital preservation to serve two purposes: to lower the volatility of withdrawals in retirement, which also could have been used with those guardrails, right? But more than this, to use it as a valuation tool for the stock market, thus alleviating sequence of return risk. So his formula for capital preservation is as follows. Safe withdrawal rate is intercept plus slope multiplied by the cyclically adjusted earnings yield. And he says that using a 1.5% intercept and a 0.5 slope basically will cushion this safe withdrawal rate and the volatility in retirement, and will plan for capital preservation in the long term. And if you want capital depletion, you can use PMT formula in Excel, and you get a higher safe withdrawal rate for capital depletion, depending on the number of years you like to plan for. What do you think about this formula, which sounds pretty similar to the CAPE rule you mentioned before?
I'll be honest with you, I hadn't been familiar with his work prior to your mentioning it to me when you sent me the list of questions, and I've looked at it on the website, and I simply don't understand it well enough to make an intelligent comment. I'll try to take another look at that and then email you with my impressions if you don't mind. I apologize. Some of these methods are very involved. My own method is sometimes hard for me to keep straight, to take somebody else's research and get into the details and mechanics of it. It takes time. So I promise to look at that and email you my impressions of that, if that's okay.
That would be great. It's a simple rule. Basically, it takes into account CAPE, right? So
Yeah.
if CAPE is 40, the earnings yield on that CAPE is 2.5%. You multiply this by 0.5 and you get 1.25, and then you add 1.5% intercept, which is designed to preserve your capital. If you use a lower intercept, let's say 1%, you might even increase your capital in retirement. But of course, you don't want to do that because you want to consume your capital if you don't want to leave a bequest. So it's a nice rule because it lowers the volatility of withdrawals. This can also be done with Guyton-Klinger guardrails, right? But those are simple discretionary rules. They don't take into account, let's say, the current market conditions, the inflation. And these rules also adjust based on the CAPE. So, for instance, if now CAPE, as said, is 40, then you have to withdraw 2.75% for capital preservation. And if you want capital depletion, I think it's almost 4% or something like that. I don't have the calculations here. If the market becomes cheaper, let's say the CAPE is 20, then you have to see how much the cyclically adjusted earnings is at the time, and it will be 5%. So 0.5 or 5% is 2.5 plus 1.5 would be 4% for capital preservation, as you said. So not only for capital depletion. So it depends on market conditions. And the way it works is that you are more conservative when it comes to withdrawals in these tough times. Of course, you can combine this rule with the tactical asset allocation as well. So if you want to do that, you can do that, of course. But
let me ask you a question. Using this rule, how much of a variation would there be in withdrawal rates during retirement? Is there, you're saying you could start out at 2.75 and go to 4 in a couple of years? Is that what this approach says, or is it a fixed withdrawal rate that you use?
The good thing about it is that you take the current value of your portfolio, so you don't need to inflation adjust the amounts anymore. Simply apply this rule to the current value of your portfolio. And from what I've seen, the volatility of withdrawals is quite low. So it smoothens the volatility. And this is great because you can't allow your portfolio to, let's say, have a 70% decline in withdrawal rates, because you still need money to live, right? I can't spend the 1,000 this month and $300 the next month. I need something balanced, and this is why I liked it. I also like the let's say your floor and ceiling spending rule, but it is more discretionary. I mean, using those 15% or 20% guardrail, right? So that does not take into account the market valuations, which, as you said, are extreme right now. So we have to somehow have a risk management tool for that. So I found this rule pretty amazing, and this is why I wanted to share it with you and maybe discuss it and see if it has any flaws or is there any issue with it, because I want to implement it for me. Of course, I have enough here until retirement, so it's not a big issue right now. But it is also interesting that this rule also works for early retirees. So those who have, let's say, 60 years to live. So not only for traditional ones. So this is why I like it very much.
I promise you I'll examine that more closely and give you my impressions. Okay?
That would be great. And also, if you can share also your rule you're working with right now with the CAPE and inflation, I would like to study that as well. At least compare them and see which are the main advantages or disadvantages of each rule, because as you said, risk management is very important, particularly for retirees, because they have both inflation risk right now and sequence of return risk. And
Just curious, what would this method advocate now for a safe withdrawal rate in this environment?
For capital preservation or capital depletion?
Well, both. Let me just each.
To be honest, I can tell you for capital preservation, whereas for capital depletion, I need to calculate using the PMT formula. So for capital preservation, right now, K is 40. So cyclically adjusted earnings yield is 2.5%, right? So 0.5 or multiply by 2.5%, it's 1.25 plus 1.5%. If you are a little bit more aggressive, that would be 2.75%. And if you want to be more conservative, you can use a 1% intercept, and that would mean 2.25. But as withdrawal also told me that is too conservative. So I think somewhere around 2.75 or 3%, it also works with a 1.75% intercept, would be pretty decent even in this expensive environment for capital preservation and perpetuity, right? So even more than 6 years, because as you said, the longer the time horizon, it doesn't affect you much in capital depletion. So it matters if the period is shorter, right? So as you said, 10 years, 9%. I don't remember exactly, 20 years, 5% or something like that. 45 years, 3.5%. And beyond that, does not influence that much the results for capital.
Exactly.
So it's pretty. I mean, I'm very interested because, as you said, CAPE should be taken into account, especially in these particular times of very, very unprecedented expensive equity markets, and we don't know what is going to happen. Maybe we will have low returns with no crash, right? Like Bob Prince from Bridgewater Associates says, it's the end of the boom bust cycle. It's let's say the period of short volatility. Everyone shortens volatility and buys the dip. That could be something, but we can also have, I don't know, a 1970s secular bear market or a 1930s. There are people who even say, okay, we have right now inflation, but wait 2-3 years, maybe we get to deflation and the bubble will deflate. So we don't know. We really don't know. I have no idea what is going to happen. And this is why I'm interested, both as a retiree or early retiree, or as an investor in risk management tools. For accumulation phase, I don't have much, except for maybe investing in less expensive equities. But for retirement, there are plenty of tools possible. Market timing using trend following could be one of them. So it boosts the safe withdrawal rate from 2.95% to more than 5% for, let's say, S&P 500 for a 100% equity portfolio, and you get out of it into cash if the trend becomes negative. So that is also something that I'm studying right now. I don't remember exactly how the paper was named, but it's pretty amazing as well. So trend following could be a risk management tool in this risky environment. Tactical asset allocation could be as well. Also, this dynamic spending rule based on the valuations of the stock market looks pretty interesting. And also, I would like to see also your rule and compare them because they both look pretty interesting right now. So I understand that it's a very difficult market environment, and it's very difficult to advise someone in this environment what to do with his money as well.
We're probably not going to know for many years what really happened to withdrawal rates in this environment. And that's a shame because you'd like to know, but I'm guessing 15 years we'll have a better handle on what was the correct approach to take today. Unfortunately, we have to live today and spend today. So there we are in a dilemma.
Spending money today means that you're no longer affected by inflation nor market crashes. So that could also be an alternative.
You never know. Hard to know.
When everything looks overvalued, like today, diversification doesn't help much. How can you protect your nest egg from all available options from a devastating loss? And how often should we check our portfolio? I do this daily.
Yeah, daily. Well, I can get addictive. I'm in the habit of doing it daily because I was managed money professionally, and I didn't want to miss anything. So I still do that today, but I don't act on a daily basis. When I act in my portfolio, I only do it occasionally, and then make incremental changes, not big changes, because I'm using an outside third-party service, and that's their approach. So I've adopted that too. I think you just have to actively manage your allocation as best you can here. My rule, once again, number one rule in retirement, don't let your nest egg get badly hurt. And the number two rule is remember the first rule. That's what it comes down to. These are dangerous times, risky times.
Yeah, I